Warren Buffett doesn't own any gold. Here's why you might want to. Behind me is Buffett's 2018 letter to Berkshire Hathaway shareholders, a letter he writes every year and shares some of his investment wisdom. This year's letter had a particularly interesting comparison between the returns of stocks and gold, one that I think could be potentially a little misleading for the average investor. In this video, we'll cover Buffett's criticisms of gold, the role of gold in a portfolio, and what I believe is a more fair comparison between the returns of gold versus that of stocks. By the end of this video, you should have a more complete and objective view on gold and whether or not it deserves a place in your own investment portfolio. Before we begin, my name's Michael, and take a second to subscribe to gain access to more investment content like this in the future. Now, if you search Warren Buffett Shareholder Letter 2018, you'll be able to find a copy of the document I'm looking at here, and on the 13th page, you'll find the section titled The American Tailwind. In it, Buffett reflects over his 77-year investment career, how America has overcome a myriad of obstacles and challenges to continue and grow and improve the quality of life for future Americans. This American tailwind has not only benefited the average citizen, but the investor as well. Buffett demonstrates this with the example that if he took that first $114.75 he had at age 6 in 1942 and invested that in an S&P 500 index fund, that amount would have grown to over $600,000 by the end of January 2019, an investment gain of nearly $5,300 for every $1 initially invested. It's no question that U.S. equities have performed quite well over this period of time. However, I think the next comparison could benefit from a bit more context and clarification. In Buffett's own words, his comparison to gold was as follows. Those who regularly preach doom because of government budget deficits, as I regularly did for many years, might note that our country's national debt has increased roughly 400-fold during the last of my 77-year periods. That's over 40,000%. To protect yourself, you might have eschewed stocks and opted instead to buy 3¼ ounces of gold with your $114.75. And what would that of supposed protection have delivered? You would now have an asset worth about $4,200, less than 1% of what would have been realized from a simple unmanaged investment in American businesses. The magic metal was no match for the American metal. So at first glance, most investors might initially agree with Buffett here in the sense that investors would likely have been better off long-term, at least over this period, to exclude gold from their portfolios and instead focus on equities or stock ownership of American businesses. While I'm personally in agreement with Buffett on his optimism for America and the efficacy of the American tailwind, I think his comparison to gold here is misleading at best, and investors would probably be better off understanding the full picture surrounding gold. In fact, there are a few specific issues that don't really make this a fair comparison. First is that Buffett's portrayal of gold as an asset class is oversimplified in his letter. Many of you likely do, but some of you may not know that gold was effectively the default currency for the United States throughout the vast majority of its history. Starting with the Coinage Act of 1792, the US dollar was defined by law as a specific amount of gold or silver. For example, a dollar was defined as roughly 24 grams of pure silver, and a $10 gold eagle equivalent to roughly 16 grams of pure gold. This meant during this period in time, the price of gold didn't fluctuate with the dollar because it was effectively the same currency. Gold continued to be used in circulation as a currency until 1933, when President Franklin D. Roosevelt made it illegal for citizens to own and hold gold. This meant that all citizens by law had to turn over their gold to the Federal Reserve in exchange for paper certificates, which we're very familiar with today. Following that, the next year in 1934, the Gold Reserve Act required that the Federal Reserve transfer all gold and gold certificates directly to the U.S. Treasury. The act also changed the nominal fixed price of gold from $20.67 per ounce to $35 per ounce, effectively devaluing the dollar by 40% overnight. That on its own is an interesting story for another video, but the end result of the Gold Reserve Act is that while the dollar is still linked to gold, only international banks can exchange their dollars, sometimes called currency reserves, for gold. Ordinary citizens no longer have that option. That international convertibility of dollars into gold ended in 1971 during the Nixon shock, when then President Nixon closed the gold window, no longer allowing international convertibility of dollars to gold, and effectively severed the last link between the dollar and gold, making the dollar a free-floating fiat currency.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
This is one of the first issues that makes Buffett's comparison a bit problematic, because from 1942 up until 1970, the price of gold was fixed, so there's not going to be any appreciation during this roughly 30-year period. This is effectively like keeping cash under your mattress, which will only lose value to inflation over time. A more fair comparison of the returns of owning gold from 1942 to 1970 would be to look at the short-term Treasury interest rates, in this case the 3-month Treasury bill, which would be the return one could theoretically generate from lending their gold or gold certificates to the US government in exchange for interest payments. This would be more representative of the actual return someone could achieve by owning gold during this period. So given that that's not included in Buffett's calculation, we know that the return of gold is likely underestimated during this period. The second issue of this comparison deals with a calculated return on stocks. In his letter, Buffett assumed the initial amount was invested in a no-fee S&P 500 index fund. The problem with investing in an index fund in 1942 is they just simply don't exist. Jack Bogle, the founder of Vanguard, was the first to create an index fund, but that didn't happen until 1975, meaning that over that 77-year investment period, there's a 33-year period where you had to rely solely on the investment returns of active investors. Now, Buffett certainly did exceptionally well during this period. However, I think even he would agree that he's likely the exception, not the rule, when it comes to active manager returns. In addition to that, since you don't have access to a low-cost index fund, you're likely paying the very high fees during that period to get those actively managed returns. The fees incurred during that period were likely well over 1%, but even at 1% being conservative, Buffett acknowledges the destructive cost of these management fees, calculating a 1% management fee over the entire period to cut in half the total returns. Now, part of the reason why index funds do so well relative to active investors, in addition to the lower fees, is something called survivorship bias. With a fund like the S&P 500, which is always invested in roughly the top 500 stocks in the US, the S&P 500 will have more weight on stocks that are performing well and less weight on stocks that are performing poorly. And if stocks perform poorly enough, they'll drop out of the index completely. What this means is that as an investor in an index fund, you are not seeing the negative returns of those stocks that have performed so poorly that they've then left the index. Active managers, on the other hand, don't have this system of cutting losses on poor performing stocks and may continue to hold on to stocks like these in anticipation of a turnaround. Either way, without the use of index funds until 1975, actual investor returns during that 33-year period are likely to be much lower than a back-tested index, because the active investors during that period in time didn't have the future foresight to know exactly which companies were going to perform poorly. The final issue with Buffett's comparison is that time periods matter tremendously, specifically the starting and end points that you use. I know the reason that Buffett used the 77-year comparison is because that's when he first started investing, but honestly, a more fair comparison window would likely be in 1971 after the gold window is closed, because then you get a closer comparison of the market price of gold versus that of stocks. From August of 1971 to June of 2019, the annualized return on the S&P 500 index was roughly 7.4%. If you include reinvested dividends over that period in time, it's roughly 10.5%. And again, this doesn't include taxes or inflation. If you look at the return of gold over that same period of time, it has an annual return of roughly 7.36%, which is very similar to the return achieved from the S&P 500 without reinvesting for dividends. But again, the time period that you select can dramatically change the results. For instance, if we take a look at the returns following the turn of the century from January 2000 until now, the annualized return from stocks in the S&P 500 was much lower, in this case now at roughly 3.8%, and only 5.8% with dividends reinvested. Gold, on the other hand, over this period in time, achieved an annualized return of 8.1%, vastly outperforming stocks over this period. This starts to put into question some of the more broad dismissals of gold, as its returns are highly dependent on the time period, specifically market conditions and valuation. So I hope that provides at least some clarity on Buffett's comments on gold here, and I think overall it's important not to just take claims at face value, but to really understand the details behind each of those statements. I think the primary message to take away from Buffett here is one of continued optimism for the US, and not necessarily a complete derision of gold. Which leads us to the next question, which is, what is gold and its role in an investment portfolio? Now, when it comes to answering what is gold, there are a couple different answers that make sense in the context of a portfolio. As JP Morgan once said, gold is money. Everything else is credit. Gold has a long multi-millennial history as a store of value. It's effectively a currency in its own right, independent of any nation, and with a limited rate of issuance based on the natural production of gold mines. If you compare that to other currencies, gold starts to look more attractive as a long-term store of value. Behind me is the Consumer Price Index, effectively tracking the price of a basket of goods directly correlated to the cost of living in the United States. What this upward sloping graph means is that over time, the price of the goods you need to maintain your standard of living have increased quite dramatically. Put another way, the value of the currency or the dollar has depreciated by quite a significant amount over this period of time. This rate of dollar depreciation or price inflation really started accelerating after the gold window closed in 1971. From 1947 to 1972, the price of the consumer index roughly doubled. This means it took double the amount of cash to buy roughly the same goods as 25 years ago. However, once the dollar was taken off the gold standard, inflation increased dramatically, and over the next 8 years, prices doubled again. And this gets into another property of gold, which is that gold is a hedge. Specifically, a hedge against inflation and central bank mismanagement. Over the period of time in the 1970s, where inflation was exceptionally high in the United States, gold over that same period was up over 1,000%. During periods of high inflation or when there's questions of whether or not the country is managing the currency properly, gold does better at any other currency of preserving a store of value. Now, in his own letter, Buffett mentioned the concern over the country's rising national debt. Now, Buffett brushed off these concerns, saying that they haven't been an impediment in the past. And while Buffett likely won't be around to see the full consequences of our rising debt, we unfortunately will have to bear the burden. The issue with being concerned over rising debt is that you never know exactly when it really becomes an issue. But you do know at some day you will meet your day of reckoning. The graph behind me is the annual rate of interest payments that the US government has to make on all their issued debt. This is the baseline amount that the US needs to spend to meet its debt obligations before they can even spend a penny on any services. The problem is that this number will continue to increase as the US continues to issue more and more debt. The amount of interest paid on US debts is already increasing faster than the amount of tax revenue being brought in, meaning that each year we pay an increasing and ever larger portion of our tax revenue just to pay off interest on already outstanding debt. We are already at historically low interest rates, so if interest rates rise in the future, this interest payment will as well, meaning that there's going to be less tax revenue for services, which will require either significant cuts in government spending, which is unlikely, or the more likely scenario, simply issue more debt. However, that brings on the problem of higher interest payments that need to be made, and unfortunately that only worsens this cycle. This is the basic argument behind the concern over the national debt. And gold allows you to hedge against that extreme tail end risk in your portfolio. Just as debt and dollar devaluation were significant concerns in the 1970s and early 1980s, as well as during the 2000s, there will likely be a time where investors are again more seriously concerned about these ever-increasing levels of debt, which will likely push the price of gold to a new higher baseline. In the context of your total portfolio, this will likely help hedge against some of your other investments, which will likely be negatively impacted over those serious concerns. And a final note about gold is that gold shouldn't be considered as an investment, but it should be considered as an insurance. During periods where the economy and markets are doing relatively well, specifically periods of accelerating growth and relatively modest or slow inflation, businesses and therefore stocks and equities typically thrive in those environments. However, it's those other economic environments that are typically challenging for equity returns where gold tends to shine. Gold will generally do relatively well in preserving its value during periods of rising inflation and also during periods of slowing economic growth. Given this, gold is a very effective counterbalance to the risk inherent in stocks. This can act as a form of portfolio insurance and reduce the overall volatility of the portfolio. One thing that I think is also interesting about this chart is that while Buffett doesn't own any gold, he certainly owns a lot of another asset that has similar properties as a hedge. And that would be Buffett's over $100 billion pile of cash that he's sitting on, waiting for more attractive investment opportunities. Now, I won't call this a direct contradiction, but I think it's interesting how confident Buffett sounds about American optimism and American businesses in his letter, and directly talks down the portfolio protection that gold could potentially provide, all while still having his own form of portfolio protection with over $100 billion in cash. There's a saying, watch what people do, not what they say, and I think this is an example where the individual investor can say, well, if Buffett is protecting or hedging his investments with his large pile of cash, maybe I could do the same. It's then up to you to decide how to do that and if gold may potentially play a role in that hedge for your portfolio. With that, we'll take a look at several different portfolios using the website portfoliocharts.com to help get a better sense of how gold performs in the context of an investment portfolio and how it can be used to help reduce risk and volatility. To do this, we'll first take a look at the total stock market index, a 100% allocation to US stocks. Now, this isn't recommended as a portfolio allocation for individual investors, but it'll be the baseline we're using to see how gold interacts specifically with the stock or equity portion of a portfolio. The median 10-year inflation-adjusted return since 1970 for the total stock market index is roughly 7.8%. The baseline 15th percentile, meaning that 85% of the time your 10-year return will be above this rate, is much lower though at 1.2%. This means that with a 100% allocation to the total stock market index, there's a fairly wide range of variability in the expected returns that you might see over a 10-year period of time. You can get a sense of this volatility and potential downside from a look at all the historical drawdowns of the portfolio or periods in time where the portfolio has fallen below its previous value. In the case of the total stock market index, an investor would have needed to stomach a roughly 50% drawdown during the worst historical case, and the longest drawdown, or the period it would take to get back to what your initial portfolio value was, took 13 years in the longest case. The Ulster Index is a relative index combining these two metrics to give you an idea of roughly how volatile a portfolio is compared to another. The higher the Ulster Index, likely the more emotionally stressful it may be to hold a portfolio with this volatility. At an Ulster Index of 16.6, 100% of the total stock market is a very volatile portfolio and one that's likely not recommended for most individual investors. However, what happens if we take that 100% allocation to stocks and add just a 5% allocation to gold? How does that impact the total returns of the portfolio, and how does it impact the risk? Interestingly enough, the median 10-year inflation-adjusted return only decreased 0.3% to 7.5%. In exchange for the slightly lower median rate of return, the baseline improved substantially more, now to 2.1%. Going back to the 100% stock portfolio, that baseline was lower at 1.2 and the median slightly higher at 7.8. What this means is that by adding a small portfolio hedge with gold in your portfolio, you slightly decrease the average or median rate of return of the portfolio, but you make up for that for a relatively significant reduction in volatility for just that small portfolio allocation to gold added. Looking at the worst case historical drawdowns, the deepest is now only 43% instead of 49%, and the longest drawdown now a year less at 12 years. Since the portfolio is still 95% stocks, it's as expected still quite volatile. However, the gold did have a positive effect in reducing the overall portfolio volatility. You can play around with these percentages on your own, but we'll just take a quick look at the 90 stock 10% gold portfolio. In this case, we do see a slightly further reduction in that median rate of return, now down to 7.3%. However, the baseline is now up to almost 3% for some investors who are more concerned with the downside risk or don't need as high a rate of return to meet their financial goals. Adding some gold to your portfolio as a hedge might make sense to reduce the overall portfolio volatility and increase your minimum baseline return. At a 10% gold allocation, the drawdowns are reduced even further, with the worst case deepest being 36% down and the longest now just 10 years. Still a long time, but as the reduction in the Ulster Index shows, it is a less volatile portfolio. Now, of course, stocks aren't the only asset class you can add gold to in a portfolio. Oftentimes, most portfolios will have some combination of stocks, bonds, and cash, from which forms your own personal portfolio starting point, where you then can frame your decision as to whether or not you want to include gold within that portfolio. This is something you can easily explore within the interactive tools at portfoliocharts.com. In addition to that, they have a really neat tool called Portfolio Finder. Effectively, how this tool works is that you set the asset classes that you potentially want in your portfolio, marking it with an R if it's a required addition to your portfolio, or a C if you are considering adding it to your portfolio. By looking at different combinations of these 10 asset classes, the Portfolio Finder can then come up with what have been the best portfolios historically by risk-adjusted return. The risk being measured by the Ulster Index, which we saw before, and the return being measured by the baseline return, or 15th percentile of the 15-year historical return for that portfolio. And one thing that I find just incredibly fascinating is that of the top 10 risk-adjusted portfolios, Again, over the hundreds of combinations that were looked at and analyzed, every single one of those top 10 options includes gold as a component of the portfolio. The only required component was the total stock market index in this case, and gold was only needed to be considered if it added value to the portfolio on a risk-adjusted basis. And based on these results, it's clear to me that gold does have value in a portfolio, especially for investors who are looking to balance both return and risk. In the investing world, when you're doing your own research, you'll likely come across many opinions, many strong opinions too, on what has worked for investors and what will likely work in the future. Gold is certainly one of those topics that can bring up a variety of opinions, something we've seen with the Buffett letter and this video. However, you don't necessarily need to take one opinion over the other and can use both to help inform your view as an investor. Whether you decide or not to have gold in your portfolio is completely up to you. However, I think it'll be beneficial to you as an investor and potentially to your portfolio as well to at least ask yourself the question instead of dismissing it entirely because some billionaire said so. I hope you enjoyed this video. Very interesting topic for me, and I'll definitely need to do a video on the history of gold later. But if you enjoyed this video, feel free to leave a like to let me know. It's the best way for me to tell which videos you enjoy most and get the most value from. Until then, thank you so much for watching. My name's Michael. I'll see you in the next video.